In the meantime, let's check stocks. China growth was disappointing. Industrial production was down. Oil's the highest in 7 years. That's your picture right now because the S&P highest since September 16th. So, Pete, I turn to you first. Should we focus on the vulnerability of stocks or the resiliency of stocks?
Oh, that's easy. I'd say the resiliency. I think we've been watching this for a long time, Scott, and we've watched how the markets are always looking ahead. You know, we look back a little bit, and then suddenly we start looking right ahead. This morning is a great example of that, actually. When you look at the markets, why were we actually down? We were down 150 points early on. Well, all of a sudden, everybody's worried about inflation. They're worried about all these other things. Suddenly, the focus got right back onto earnings, and I think that's what really sort of turned things for us, and that's where we started to see the markets rocket to the upside. We've been talking about oil for a long time. It was $38 a year ago, and here it is, 83. So it's not like it snuck up on us, but I think a lot of people are finally starting to catch up on the idea that, yes, it's been for real. This rally has been real, and we have to obviously trade around that. But there's going to be a lot of different ups and downs. But I think we've shown a lot of different times where the opportunities are on these sell-offs. They are by the dips, and they have been. They've been right. Last week, I bought more Target. Target's now significantly higher. I think that's exactly what we are seeing right now is when great names get pulled to the downside, you've got to have your list out and look for those names. If they're getting pulled with the markets, I think you have to make a decision.
All right. So, Shannon, I asked at the very top whether a top market watcher is about to capitulate on his correction call. And I'm talking about Morgan Stanley's Mike Wilson, frequent guest of the program over the last 10 years. He says today, and I quote, "Retail proves resilient and buys the dip once again, forcing many institutional investors who share our fundamental views to cover and chase. Meanwhile, earnings revisions are deteriorating, but not fast enough to cause a bigger decline in the broader indices. Yet, this is somebody who said we're going to have fire and ice, a greater than 10% correction. I wonder if he is laying the groundwork today to capitulate on his big correction call."
Well, I'm not going to pretend to know either way, but I think there's two good points that you make. Number one, earnings revisions generally do come down as the year goes on. You start off really optimistic, or the analysts do anyway, and they come in over the course of the year, and we haven't seen that. So, you know, there's a little bit of perhaps normalization in earnings. Second, if you think about, you know, all of these institutional investors who are capitulating, if you will, they're just waiting for a bigger pullback. It's not like they are necessarily worried about equities on a longer term basis. They just don't like the valuations they're having to pay right now. So I think, you know, the retail investor, whether they're buying the dip or whether they're just continuing to put money into equities because that's the only option right now to be able to earn a decent return. I think these institutional investors have been waiting for a pullback. They just wanted something bigger so that they could justify those valuations going into year end.